the Goldmine Podcast.
The one question that I have, or the one thing that kind of sticks out to me, at least at the beginning, is like, you were running a fund of funds model essentially in 2006. This is way before anything would you say like you were kind of pioneering that model, or walk me through kind of how that was born? Like, what was the birthing of that?
Yeah, I'd say we were. I mean, there definitely wasn't a bunch of other people that were tilting up investment funds to allocate into others, at least at this scale, right? I mean, certainly at the institutional level, it's been going on for years, but to do it where you're raising high net worth money and then allocating into sub-institutional sponsors, no one did that. And obviously now it's a really big segment. I call them, we were capital allocators. That's what I call people who executed the strategy like us. The reason we got into it is because, post global financial crisis, we were very conservative. We were hard money lenders. We're very conservative. I mean, we underwrote the deals, our average loan to value is 55%. We just felt like, rates were coming down and a lot of guys were entering the market, and we just felt like we weren't, it just the risk adjusted returns. We didn't feel good about it, right? Like, we're not willing to lend, be that aggressive on advance rates and interest rates. So we just looked at ourselves and said, what are we really good at, right? What can be the best in the world at? And we felt like we understand all the complexities of these capital structures and securities laws. And we understand we know what a good real estate guy looks like. We know what the people that are good at what they do, how they do it, how they underwrite, how they model their deals. And so that's kind of how we got into it. Like, rather than us picking a specific strategy and being operators ourselves, this will allow us to sort of skate to where the puck is going. And that was part of our thesis, right? Was that, so we went kind of long on multifamily, starting like 2014 to, everyone was sort of in multifamily, en masse. And then the same thing, like with, doing conversions of big box retail to self-storage. We got into that, conversion of extended stay hotels into, workforce housing. So we like to have that thematic flexibility to kind of go where the opportunity exists in the market. So that was kind of how we got into that.
Makes sense. Yeah, it's interesting. And I definitely want to spend some time on, your thoughts on how to architect a fund and all of that good stuff. And then we'll get into some of the things that you're doing right now with Passive Advantage and whatnot. But I'm curious, when you were first starting, what was it about emerging sponsors that drew you to them? Is it because you thought, okay, we can get better terms from these guys? Is it easier to kind of establish a relationship at the ground floor as opposed to someone who's a little bit more established? Walk me through the reasoning behind that, because a lot of people shy away from like emerging sponsors who are like, I don't want to deal with this. I don't want to put my risk. Feels like a lot more risk, right?
Yeah. Well, I think, a few things. One, we felt like, we could just negotiate better terms. And we've just believed that when they're emerging, if you pick the right groups, they're going to work really, really hard for you, right? Because they got something to prove. But at the same time, what they lack is they just lack the relationships, right? So like, and most of the guys that we targeted were the ones who really loathe the fundraising process. Right. So for them to find a strategic partner who could ostensibly be a big part of that solution, I think it just worked out. Like, you take us plus them and you get, a really great end result for all parties involved. And then, because what happens is that the longer you've been doing it and the more you track record, the more traction you get, you can't really negotiate. I mean, you earn the right as a sponsor to charge more fees, right? Like, it's like, the promote won't be as great. Like, we believe that, right? Hey, if you've been doing this a long time, then your experience and the track record is sort of de-risked any deal that you're in. So for us, it just felt like, we did things that others, I don't know how many people do this, but we would negotiate like enhanced information rights. And obviously we're administering, that was one of our things, like we have to administer these vehicles. So we felt like there's ways for us to mitigate the risk that you had with emerging folks, where we're kind of doesn't sound right, but the adult in the room, so to speak, of just being able to monitor them more closely, help them make sure they're making good decisions along the way. And it got to the point where we actually were able to negotiate, control rights alongside, as true co-GPs with many of our sponsors. So our whole thing was like, let's grow with them. And at some point, they'll reach a point where maybe they won't need us anymore, and that's fine. That's fine too. So that's how we looked at it. But the key was always just find the guys who are really great real estate guys. And they often come from the brokerage community, right? So they were representing buyers and sellers, and they've been doing it for a long time. They just haven't necessarily been acquiring it on their own for a long time.
Yep.
Yeah. And we had good success with that. I mean, it was a good model, and continues to be a good model for my former partners.